turn this over to Matt. He's going to tell us about long-term care and some great products that they have to offer. Take it away, Matt.
Thanks, Greg. Good morning, everybody. Appreciate your time. Before we get started I do want to make note of the question box. Everybody is in a listen-only mode. We have a number of attendees, so to mute everybody, but we do want your questions. So if you have those questions, please type those in on your box there on the right-hand side of your screen. I'll make sure that we get those answered for everybody at the end of the webinar. So we'll go ahead and get started. But I wanted to start off by just talking about the opportunity that we have with long-term care, the importance of long-term care planning. And I know in a webinar format we can't I can't see everybody's hands, but I just want you to picture, when I do a client workshop or a client seminar, the first thing I ask the audience is, raise your hand if you think somebody in this room is going to need long-term care. And as you can imagine, every single hand goes up. The next question I ask is, raise your hand if you think you're going to need long-term care. And all of those hands go down. Now, there's a few of them that are convinced themselves that they are going to need long-term care. They're going to wind up with Alzheimer's and go into a nursing home. But most of those people don't think they're ever going to need care, but it's the biggest risk that they face in retirement or when they're nearing retirement. So there's a tremendous amount of opportunity that's out there, and we'll get into some of those statistics and some different ways to start that conversation with the clients instead of just scaring them into the nursing home and talking about the risk. So we're going to talk about some language, again, to start that conversation. But for those that aren't familiar with OneAmerica and our Care Solutions portfolio, we are a leader in the asset-based long-term care market. We have life-based products, annuity-based products, so really pioneered this and the multiple funding strategies that we'll get into here in a little bit. Very, very highly rated, A+ rated by AM Best, AA- by Standard & Poor's, and you can see there, we're in an elite category, an elite superior ratings. Only 7% of life insurance carriers can boast that. So very, very elite to give you the confidence that we're going to be there on the back end when those customers need them most. This is a really busy slide, but it gives you the flexibility of our plans. We have both life-based plans and annuity-based plans, and you can see there we can fund it with any kind of money: cash, CDs, savings, IRAs, 401ks, 1035s from existing annuities, cash values from life insurance. So as long as they have money, we can find a way to fund one of our plans, and we'll get into the differences and when to use one and where to use the other, and why one over the other. Some of the hallmarks of our product portfolio on the asset care, it's a whole life insurance policy with long-term care benefits. We have a patented joint life coverage, so we can cover two people. Typically I'll say husband and wife, but it doesn't have to be husband and wife. We can cover two people with an insurable interest for long-term care. So maybe you have a mother, daughter, or two brothers, two sisters. Think about the 3 Bs. So I heard this the other day. If they're blood, they live on the same boulevard, or business. They live together, they have a business together, or they're related, we can probably cover them under an insurable interest and get coverage for two people under that one plan. Lifetime benefits for long-term care. We're still the only carrier out there offering lifetime coverage for long-term care. And then the third thing there under the asset care is we're IRA friendly. Okay, on the annuity care side, which it's a single premium annuity with long-term care benefits, we have some indexing options. So we have an indexed product. We have a fixed product. We can get, double, triple lifetime benefits on the back end. And again, we're IRA friendly. A lot of us, that are in the financial services field, maybe you're an advisor, you're a planner, you're an insurance agent, whatever that title is, we do a great job of planning for our clients and getting them up and to the point of retirement, and then the income planning after retirement and making sure that they have enough to live off of. The one thing that typically gets left undone is the long-term care. Don't forget about that third leg of the stool, because without that long-term care, it's going to tip over. Okay? So we do a great job with the income planning, the wealth transfer, the retirement. Don't forget about the long-term care. You know, I think that's the most critical piece to that. If you don't do the long-term care, you could potentially wipe out all of the other planning that you have done for those clients. Okay, this is a lot of words on this slide, but the biggest thing I want you to look at is that 3%. Okay, only 3% of Americans over age 18 have long-term care insurance. I think there's a little bit of background noise. If you could mute, that would help out a lot. So only 3% of people have some type of plan in place for long-term care. And what that tells me is that we have a tremendous opportunity, a huge opportunity, because most of these clients out there are self-funding. Okay, there's a couple of statistics on here. You know, the one under why it's important to prepare. 70% of Americans turning age 65 will need some form of long-term care in their lifetime. Now, what I would tell you is that 100% of your clients think they're in the 30% that are never going to need care. Okay, so if you're talking to your clients about, you know, the risk and the 70% chance of needing care, I'd strongly encourage you to think about a different approach that we're going to talk about here, and talk about the consequences, not the risk. Not going to spend a tremendous amount of time on the expense. We all know that long-term care is extremely expensive, and it's not getting any cheaper. I think one of the panelists is still not muted. So if we could make sure that everybody's muted, that'd be helpful. So the average cost of care, you know, in 2010, about $83,000, and again, it's not getting any cheaper. Some of the reasons, you know, why they're going to impact that, obviously medical technology, family dynamics, the government, baby boomers, a lot of impact there on those costs going up. So it's very, very important to take care of this. And again, some of the statistics here, 70% that we just talked about. And most people, almost every single presentation that I've done with clients, and even advisors, you know, what's the average length of stay? And that's a very hard, you know, question to answer, because, and to my knowledge, there's not any good statistics out there that encompasses all of long-term care. What we have up here is for a nursing home, over 40% will need care in a nursing home, and on average, you know, women 3.7 years, men 2.2 years. Okay, but that doesn't have any impact on home health care, assisted living, or maybe a family member providing that care. So you'll see out there a lot of 2, 3, 4-year policies to cover that nursing home need. But what about all the other care? Most people don't just wake up and go into the nursing home. They get care at home, then progress to assisted living, and then maybe ultimately into a nursing home. So just keep that in mind when you get that question asked by your clients. But understanding the real cost here, you know, it's punishing your spouse. It's the family dynamics, the adult children, and the unnecessary losses. So 2 questions to ask every client. Number 1, you may never need care, but if you did, how will that affect your family? Okay, so it's family first, not finances. So you may never need care, but if you did, how will that affect your family? That's a great way to start that conversation with the clients. You know, Mr. and Mrs. Client, I've done a lot of things to help you prepare for retirement, but, you know, one of the things we've never talked about is long-term care. You may never need it, but if you did, have you thought about how that would affect your family? And then secondly, if you did need care, how will you pay for it? Okay, so again, notice the order there, and that's critically important. Okay, It's family first, not about finances. If you're talking to me, I'm 37 with a wife and 3 kids. If you're talking to me about how expensive it is and the chances of me needing care, I'm probably not going to pay very much attention. You start talking to me about the impact to my family, to my wife and 3 kids, now you got my attention. Okay? So let's spend a few minutes on this first question here. You may never need care, but if you did, how would that affect your family? Okay? 4 important considerations here. First and foremost, if somebody needs care, the first line of defense is typically the spouse. And some of you have witnessed this. Some of you went through this, maybe with some of your clients, some of your family. But, you know, oftentimes caring for a chronically ill person makes the caregiver chronically ill. Their health deteriorates very, very quickly. Okay? If there's not a spouse involved, oftentimes it's the children. Okay, so other loved ones carry the burden. A lot of times it's not just any children, it's the oldest daughter who lives closest to mom and dad that has to quit their job, move in with mom and dad, or mom and dad move in with them to take care of them. You know, giving up their family, their career, as any good child would do and feel obligated to do. But as a parent, is that what you want? You know, so have that conversation with those clients. You know, they're probably thinking about them coming over and having a quick discussion, or, you know, having a meal with them, maybe cooking a meal, cutting their grass, doing laundry, those types of things. But that oftentimes there's a huge impact to the family dynamics. When care is needed, it's typically not shared equally. I tell people long-term care does not bring families together. It tears them apart. You know, just a quick example with my family. I live here in Atlanta. My family lives in Indianapolis. My sister lives 2 minutes away from my parents. If something were to happen, she's going to be the one to bear the brunt of most of that care and that burden, and giving up her career and her family. How's that impacting our relationship? Unless I quit my job and move back to Indiana, I can't be there day to day. I can provide some funds and I can go and visit and do some things, but she's going to be the one bearing the brunt of most of that care, and that's going to have an impact on our relationship. I said this at a meeting a couple of weeks ago, and I said, how do you think Thanksgiving's going to be, you know, after mom and dad passes away? And then we've all seen it at the financial, you know, office, you know, meeting with the advisor or the attorneys, and now the assets are getting split up, and they're getting split up equally. You know, and I said, well, how do you think Thanksgiving's going to be that next year? And some old lady in the back of the room said, there won't be a Thanksgiving, you know, and she's probably right. You know, long-term care, again, does not bring families together. It tears them apart most of the time. And the final thing there is the unnecessary losses. Obviously, we can't avoid everything and all the losses, but the unnecessary spiritual, emotional, financial, and familial losses could be mitigated when your clients are prepared. So having a plan in place, and that plan may be a traditional long-term care plan. Maybe it's an asset-based plan that we're going to talk about here. Maybe it's a competitor's product. Maybe it's another investment product out there. They got to have a plan in place for long-term care, because as we can see on this next slide, if you do need care, how will you pay for it? And it's pretty easy, folks. There's only 3 ways to pay for care. Okay, they can, you know, require government assistance through Medicaid. They can buy a long-term care insurance policy, or they can pay for it out of their own pockets. Okay, now most of your clients that have assets, Medicaid is never going to be an option for them. Even if it is an option for them, they're going to give up complete control and go to the one place that most people don't want to go to, which is the nursing home. Secondly, long-term care insurance. And if they want to buy a long-term care insurance policy, sell them a long-term care insurance policy. But I know that 90 to 95% of the people out there are not going to buy that policy because they think it's expensive, it's hard to qualify, and people do not like the fact that the premiums could go up, and they view it as a use it or lose it type of a policy. And I used to beat my head against the wall when I first started out in this industry, 16 years ago with John Hancock, sit down, do a financial profile for a client, get $2 million in assets, over $200,000 of income, and I show them a $200 a month premium, and they tell me it's too expensive, they can't afford it. And I'm thinking, what am I missing here? They don't think they're going to need long-term care, so $10 a month is too expensive for them. So what most of the clients out there end up doing is self-funding. And all we're going to do is simply show them a better way to self-fund. So a typical client profile is around age 65. I think our average issue age is right around age 65, 66, 67 or so. Obviously, we can go down to 50. We can go up to 85. We can actually go lower than age 50, but not many, 18 and 20-year-olds are worried about long-term care insurance. 250,000 of investable assets. Okay, the main thing that I want you to realize here is this is money that they don't plan on using. If they need this money for income purposes, this probably is not the right approach for them. Okay, it's that never money, that rainy day money that, God forbid, they did need care. That's the money that they're going to use. They don't have to be in completely good health. Up there on the screen you see fair health. The main things that we look for, obviously in the marketplace that we're in, there's going to be bumps and bruises. The main things that they look for is if they do have those issues, is it controlled? So strokes, cancers, diabetes, high blood pressure, those types of things, if it's happened in the past and it's not debilitating and it's controlled, we shouldn't have a problem offering some coverage. Okay? And again, these people have looked into long-term care insurance. They're not going to buy it. They're not going to qualify for Medicaid, so they're self-funding. So just a quick snapshot there of that client profile. So let's get into the asset care, which is our life-based long-term care. Okay, now you see up here on the screen our portfolio. One of the great things about our portfolio is the flexibility. On the flip side, one of the downsides to the portfolio is the flexibility. Okay, this is not a one-size-fits-all. Depending upon the client's need, their situation, where the money's at, their health, we may have a different option for that client versus another client. So again, it's not one-size-fits-all. We're going to focus first on the asset care, which is a life-based approach. You can see there's 4 different versions there. Don't get too caught up into that. Okay, the main thing, the difference there is the different funding options. Okay, funding it with different types of money, which we'll get into here right now. But the first thing I think we need to understand is, how asset care works. How the basis of this works. And all this is a life insurance policy, a whole life insurance policy, where the death benefit can be used for long-term care. Okay, so here on the screen we got an example here. This is about a 65-year-old couple. They got conservative assets, they got moderate assets, and they got aggressive assets. And that's a really, dumbed-down financial portfolio. But I show it this way because I always want to show those conservative funds. I never want to get into an interest rate battle. If they are shopping interest rates, or you as the advisor are shopping interest rates, there's a better place to put that money. That's not what this is designed to do. So they're not earning much in that conservative portfolio now. We're going to reposition that, move that from their left pocket into their right pocket. By doing so, now we've leveraged that money, and now we have $252,000, $250,000 available for long-term care. Or if they die and they never need it, the beneficiaries are going to get that money. So whether they live, they quit, they die, they have benefit there of this policy. They want to quit and walk away. In this example, they put in the 125. They'll never get back less than the 125 that they put in. They die, they never need care. Beneficiaries get $252, income tax-free like any other life insurance policy. They get sick and need care. They're going to have access to that $252 for long-term care. Okay, so Asset Care 1, that's the single premium. This is probably what the plan that we're most well known for, the flagship plan. We do a lot of single premium business. So a quick case study here. Client's got cash value somewhere. We take $150,000. We reposition that from a CD, Now we got 150 in cash value, death benefit of 250,000, and $5,000 per month per insured for long-term care forever. Okay, so on this joint couple, and it's important, to note that we can do a joint plan. We can also do an individual plan, so they do not have to do a joint plan. So we can still help out those individual clients, maybe that are widows or divorced. We can help them out just as well. Maybe structured a little bit differently, but we can still certainly do individual policies. So here we've taken that CD, 150,000, repositioned it, moved it left pocket to right pocket. By doing so, again, $250,000 death benefit, $5,000 per month per insured. And what's important to note is on a joint plan, they both have access to the $5,000 per month. Okay, that's a $5,000 per month per insured. I get sick, I need care. We're paying out $5,000 a month for me. My wife gets sick, she needs care at the exact same time. We're also paying out $5,000 per month for her. So if we're both on claim at the exact same time, the company's paying out $10,000 per month, and with that lifetime rider, we have an unlimited pool for long-term care. We die, never need care, beneficiaries are getting $250,000. Okay, so that's the Asset Care One, single premium, cash. Okay, here's a cutout of the illustration, and there's two ways to get that lifetime rider. Okay, the first way, we can reposition $125,000, and then down there at the bottom you see the optional LTC continuation benefits rider, $1,200 a year. Okay, so we can make it lifetime by paying $100 a month. Okay, or some of your clients do not want to pay an annual premium. Here's the example here, taking $146,000 and doing a single premium for that lifetime rider. So they put in the $125,000 into the base policy, plus the $21,000 for the single pay lifetime rider. They've now repositioned $146,000. Now that's a comfort level, obviously, for you and for the clients. I love the simplicity of being able to sit down with the client, with the customer, and saying, hey, Mr. and Mrs. Client, we're going to take and reposition $146,000. We're going to move it from here into here. That's going to give you $5,000 per month per insured forever, no matter how long you need care. So I really like that approach. The one downside to that, sometimes from the advisor standpoint, is that you don't have the flexibility of saying there's a guaranteed return of premium. That $21,000 has a 1-year free look. So they write a check for $146,000. They get back the $146,000 all within that first year. But if they decide to quit and walk away in year 2, they're only going to get back the $125,000. Now, I've been with the company over 10 years now, and I've probably had less than a handful of cases that have ever been free looked or surrendered. The clients are very, very comfortable with knowing that they can get that all back in the first year and $125,000 of it in years 2 through. Okay, but if that's a crutch and you can't get beyond that, here's the approach here, and show them putting in the $125,000, and then you can tell them absolutely they'll never get back less than the $125,000 that they put in. So to show you real quickly how that cash value looks, you can see there under the cash surrender value, the $125,000 stays constant there for the first 6, 7, 8 years, and then it starts growing. So sometime between years 10 and 11, even if they did that single premium rider, they're back up over what they put in. Okay, so they put in the $146,000 and have the lifetime rider built in. They want to walk away in 11 years, they're getting back more than what they put in. Okay. Now, not all of your clients and customers have access to $150,000. Maybe they're younger, they don't have that single premium to put in. We're doing a lot of business, and this is our fastest growing product right now, is the Asset Care 4, and that's just funding it as an ongoing premium, as an annual premium. We can do it as a 10-pay, we can do a 20-pay, so we can really be flexible with that for those clients that don't have that single premium. Okay? Let me give you a sales idea here real quick. Our number one producer in the company right now does nothing but this product. Okay? Their office does a lot of annuity business, and all they're doing is simply turning on income from those existing annuities to fund long-term care. Okay? So a great opportunity to generate some revenue without gaining a new client. If you're out there selling annuities, take a look at some of those annuities that have some income privileges. Now again, if they need that to live off of, this may not be an appropriate approach, or maybe we don't want to take all of the income. But here's a case study. Client's got $178,000 in an annuity. We take an income distribution of 5%, that's generating $8,900 a year. We take that $8,900 a year, put that into an asset care, that gets them a death benefit of $300,000 and a long-term care benefit of $6,000 per month per insured forever. Okay? So just turning that income stream on, $8,900, now a $300,000 death benefit, $6,000 a month per insured lifetime coverage. And again, under a joint plan, that's $6,000 per month for husband, $6,000 a month per wife, or whoever the joint insureds are. Okay? So an excellent opportunity there to generate some revenue, create some long-term care just by utilizing one of those existing assets there. Okay? Maybe they have some of those annuities that are two-tiered and they only get the bonus if they annuitize it. We're seeing a lot of business coming in that way, where they go ahead and annuitize that contract where it's at and take that income to match up with this. So they do a 10-year annuitization and then fund an asset care. The beauty there is if they die early, then what they're able to do then is to take the income. They're going to continue to get that for the rest of the 10 years, plus they have the tax-free death benefit on the asset care plan. So an excellent opportunity there with some of those existing annuities. Okay, so here's this example here, 60-year-old couple, $6,000 a month. You see the base contract premium, $7,700. Lifetime rider, a little over $1,100. That's roughly the $8,900 there. For those that are selling traditional long-term care, and again, if they're buying long-term care insurance, continue to sell it to them. But again, I know you're getting a lot of those objections, too expensive, they can't qualify, underwriting's tightened up, premium's going to go up. Here's a quick example, and you know these numbers may have changed, but conceptually, I just want you to kind of understand where we're coming at. If you're looking at long-term care insurance, I would strongly encourage you to look at asset care 4. A lot of times the premiums are not that far off. So here we got a 65-year-old couple, $5,000 a month. With us, we're looking at lifetime versus 10 years per insured with the other carrier, 30 days, you know, similar elimination periods. Both have waiver of premium. Neither have inflation protection. The death benefit, if care is never needed, $125 with us, 0 for the traditional carrier. Guaranteed cash value, obviously there's none on the traditional side, $35,000 and $73,000 on the long-term, on the asset care. Both of them are tax qualified. The biggest thing is, in my opinion, is that down at the bottom, guaranteed premiums. Our premiums are guaranteed. So again, guaranteed premiums for long-term care never to increase. We're the only carrier out there still offering guaranteed premiums. So this premium, you know, a little bit over $500 more expensive per year today, you know, but when are they going to get that premium increase? How long until they get that premium increase? Okay, and have that premium exceed, you know, what they're paying with us. So a guaranteed premium for long-term care, never going to have to go back to those customers and say, well, sorry, but your premium's going to go up. Okay, so if you're looking at traditional long-term care or need to fund something as an ongoing premium, Asset Care 4 is a huge opportunity. Qualified money is getting more and more popular. Most people these days are socking all the money they can into their retirement accounts. So it is growing, and it's going to continue to grow more and more each and every year as those 40 and 50-year-olds, 60-year-olds get older and looking at long-term care. So won't spend a tremendous amount of time on this, but I want you to know that it is available, so we can certainly use qualified money. I encourage you, if you're going to be talking about the long-term care, the asset care, talk about what we just did before. Then when you get to that point, what I like to show is conceptually, like we just talked about, repositioning left pocket to right pocket. And then if they say, well, that sounds great, but the only money we have to use is qualified money, then it can be an easy transition. Say, great, we can use it. It's just going to work a little bit differently. And let me show you how that's going to work. Okay, we're going to take an IRA, an existing IRA, and we're going to move that from their existing IRA into an IRA with us. Okay, so obviously we know you can't go directly from an IRA into a life insurance policy. So all we're doing, folks, is packaging this in, putting that IRA into an annuity with us, and then each and every year we're going to take a distribution out of that IRA. So $125,000, about $8,000 per year. Now, that's a taxable amount. Okay, that's a distribution out of the IRA. They're going to pay taxes on that. But instead of paying taxes on the $125,000 all up front, we're going to spread that out over a 20-year period. So as time goes on, the IRA is getting smaller and smaller. The life policy is getting bigger and bigger. So again, we got, the base plan, 50 months. Then they can add, additional 50 months or lifetime coverage, just like we talked about with the other asset care versions as well. Okay, so we take the 125, do a distribution of the 8,000. Now we got a life insurance policy and an annuity tied together. They need care. They got access to the full amount. They can add all the same riders that we just talked about. Okay, so just a quick diagram here, and this is a client-approved piece so that we do have this out there. So if you're presenting an asset care 3 or talking about the qualified money approach, we can look at that. The numbers are a little bit different here, but you can see as time goes on, that annuity is getting smaller and smaller. The life policy is getting bigger and bigger. Now we'll jump into the annuity care portfolio here for the next few minutes, and then if you have questions, make sure you're typing those in, and we'll leave some time at the end to get those answered. The annuity care portfolio, very similar, single premium annuity with long-term care benefits. Now, I did say this earlier, but my goal is not life insurance versus annuity. Okay, my goal is to get your clients and your customers the best long-term care plan we can. I don't care if it's in the life insurance and the asset care, or in the annuity versus in one of the annuity care products. Okay, again, my goal is to get them the best long-term care plan we can. And what's going to determine that is the customer, the client's age, their health, and where the money is at. Okay, so the annuity care portfolio, you see there's a couple of different versions there, but there's a huge opportunity out there for annuities. Okay, now these are some old statistics, and some of you may have seen these before, but there was in 2008 $1.57 trillion in annuity assets. In 2008, there was $141 billion of annuities sold, non-qualified annuities. Okay, the average purchaser was age 66. Okay, so that was 7 years ago. Okay, here we are in 2015, 7 years later. That 66-year-old customer is now age 73. Perfect opportunity for those folks. how many will die with that annuity? Okay, according to a survey in 2009, 83% intend to use their annuity as a financial resource to avoid being a financial burden on their children. 73% intend to use it as an emergency fund in case of catastrophic illness or nursing home care. Okay? They've already, folks, identified this is the money that they're going to use for long-term care. Why not reposition that, put it in the right pocket for the right purpose, and make it better for what they're trying to accomplish? Okay? We're in a changing marketplace. If you're talking about interest rate, these folks probably are not going to move that annuity. You know, at 73 years old, you know, what were interest rates in 2008? Why would I move my annuity from a 3 or 4% guaranteed minimum interest rate into a new annuity product with a 1% interest rate? Okay? The only person that that's probably good for, you know, in a lot of scenarios is us. Okay? Why would they move that? Okay? So if you're talking about interest rate, they're probably not going to move it. But what's more important to them is the value that annuity care and the Pension Protection Act can offer them. Okay? Thinking about taking that annuity, reposition it, multiplying it for long-term care, and if they need it, it's going to come out income tax-free. So just real quickly on the Pension Protection Act, and I know we've done some webinars in the past on the Pension Protection Act, but it was passed in August of 2006, went into effect January 1, 2010. Only funded those money dollars funded with after-tax dollars. Okay, and it doesn't apply to all annuities. Okay, so it has to have certain language in that contract, and what it allows for is distributions to come out income tax-free for long-term care. Okay, so we got an existing annuity, $50,000 basis, $100,000 gain, $150,000 cash value now. They need long-term care, they're going to pay taxes on it. If we 1035 that in one of the annuity care products, that money's going to come out income tax-free for long-term care. So a great way, again, 95% of those people out there are going to pay for care out of their own pocket. 73% said they're going to use the annuity to do so. Why not reposition that annuity, let them use tax-free, tax-advantaged dollars to do so? So very similar to the asset care, this is a leveraged benefit for long-term care. We can double, we can triple, we can get lifetime coverage on the back end of the annuity-based products. Annuity care is the first annuity product that we have. It's a fixed annuity. They're going to use that fixed annuity for the first 3 years, and they have an optional rider that can be added to add an additional 36 months or lifetime coverage on the back end. Okay, so here's a quick sales idea for you for an 81-year-old female. Okay, so yes, an 81-year-old female got $125,000 in a non-qualified annuity, does not need that money for income. She's sitting on a 3% guaranteed minimum interest rate. We can reposition that 1035 that $125,000 and include that lifetime rider, and now we can give this client $36,000 per year of tax-free benefits for long-term care forever. Okay, just by simply 1035 in that existing annuity of $125,000, now we've generated $36,000 a year of long-term care benefits tax-free forever. Okay, so if you got some of those existing annuities out there, we can look at a way to reposition that, include one of the riders in with that 1035. So an excellent opportunity there under the annuity care, okay, but that rider is optional. Annuity Care 2 is one of the newer annuity products that's out there. The beauty of the Annuity Care 2 is that rider is built in to the annuity. So we reposition that money, 1035, they write a check, whatever it may be, okay? That rider's included, no out-of-pocket premiums. It's all contained within that single premium. The options that we have here, they can get 2.5 times, 4 times, or 5.5 times for long-term care. So we can take that client's $100,000, reposition that, turn it into $250,000, $400,000, or $550,000 available for long-term care. Obviously, as we step up that ladder, we go from 2.5 to 4, or 4 to 5.5. That internal charge is going to be greater in certain situations. You know, obviously, it's going to be higher. There are some situations where you may run into where the internal charge is greater than the interest rate that we're crediting. Okay, let me show you how that looks. Client puts in $100,000. I've chose that middle option, turn it into $400,000. Okay, based on the guaranteed interest rates, you can see there that that client's accumulated value is going to decrease. Okay, so that $100,000 in 10 years, the client passes away, never needs long-term care. The beneficiaries are getting $96,561. So they put in 100, now it's worth $96,561. It's cost that client a little over $300 a year for long-term care. Okay, very, very cheap, inexpensive long-term care. Okay, now if you're uncomfortable with that, okay, what we can always do is back that down to the 36-month or the 2.5 times rider. And in most scenarios, unless we get up into the late 70s, that's going to flatten out, and what they put in is about what they're going to get out. Okay, indexed annuity care. I won't take a lot of time to go through this. This is probably something we'll do a webinar in the next few months once we get an illustration out on that. It is available now. It does work extremely well in certain situations. So if you got a lot of experience with indexed annuities, very familiar with indexed annuities, this is a great option here for some of those clients. Again, we can do 1035s, or they can fund it with cash, single life or joint, double, triple, or lifetime coverage for long-term care. It is indexed to the S&P. There is a bonus that they're given for long-term care as well. So an excellent opportunity there. Takes both cash, 1035 exchanges, qualified money. So again, any kind of money, we can find a way to fund that. A couple of things I want to just end up with here. I want to give you one more quick sales idea, talk about the underwriting process, and then we'll open it up for any of the questions if there are. Okay. So we talked a lot about 1035 opportunities. Okay, we don't have to do just full 1035s. So maybe they have that big one out there, that $400, $500, $600 million. Just sat down with a client last week, got over $1 million in an existing annuity. Okay, a lot of gain in it. Obviously, we'd love to get the $1 million, but we certainly don't need the $1 million, okay, to get the long-term care protection that the client needs. So we're looking at 1035, and we backed into the number. We're going to do a 1035 exchange of $200,000. Now that's going to get them the long-term care benefits that they want and they need. Keep the other 800 plus in that existing annuity. So we can accept partial 1035 exchanges out there as well. So keep that in the back of your mind. We can also do a 1035 exchange and add that spouse on as an eligible person. Okay, so this was her annuity. We 1035 the $200,000. This is her annuity. We then add him on as an eligible person, and now both of them have tax-free benefits for long-term care under her annuity. Okay, so we can add that that spouse on as an eligible person as well, so they both have access to that. Okay. Underwriting. The underwriting on the annuity-based products is less stringent than the asset care. On the annuity care, it is just the telephone interview and the application. Okay, so again, just the app and the telephone interview, no exams, no physicals, no blood, no urine. Okay, just the app and the telephone interview. We try to do that same process with the asset care. We try to do it just based off of the app and the telephone interview. If they've been declined, if they've had some health issues, they've been rated, if they haven't seen a doctor in the last year or two, then they may move the asset care, the life-based plan, may move that to full underwriting, which could consist of a paramed exam and APS for medical records. Okay, so we try to do it through that streamlined underwriting process, but have the flexibility to move it to full underwriting under the asset care. But again, on the annuity product, just the telephone interview and the application. And I think Linda has our pre-screen. If you have any clients that have some health issues or concerns, we can always run those by our underwriters and see if they would consider them for the asset care or the annuity care. We get a response back within a few hours, and they'll say, yes, we'll consider, or no, we won't, or yes, we will for the annuity care, but not the asset care. Okay? Coming up to the end of the hour here, so I do want to make sure we get those questions answered. So if you have those, type those in the box there, and we'll make sure to get those answered. Are there any questions?
I do have an initial one here for you, Matt.
Okay.
Basically, I see the slides that are company and recruiting and not for public distribution. They were wondering if you have similar slides that they could use for public distribution used in front of their clients.
Yes. The slides that we have here, obviously, these are producer-only, producer training. We do have a client-approved seminar. So if somebody has interest in that, send me an email and I can get that out to you. It's very similar. It just doesn't go into all of the details here that obviously that we have went into, but we do have a client-approved PowerPoint as well.
Okay, now I have their email address I can send over to you, Matt.
Okay, great.
See, is annuity care single premium? Is single care single premium only, or is flex available?
For the most part, the annuity care plans are single premium. We do have some limited options to be able to spread that out over a 4-year period. So if somebody's wanting to put in $100,000, we can do a flex pay of like 4 years and do $25,000 for the next 4 years.
Let's see. Any underwriting concessions for a multi-life case?
We do not offer multi-life cases. Everything's individual.
All right, now, so we'll give it another minute, see if any other questions show up.
Okay. And as people are thinking through those questions, if you have some questions that pop up in your head later today or tomorrow, reach out to the folks at Milner Group, and they can get in touch with me, and we can get all those questions answered if they come to you later in the day.
And now it's probably a good time to mention, too, we do record these webinars, so it will be available for replay on the website here later. All right, I believe that is all the questions we have at the moment.
All right. Well, I'll go ahead and wrap up my end, and I don't know if there's if anybody else has anything to finish up, but I appreciate everybody's time. Appreciate everybody at Milner Group to put this together. If I can be any help, don't hesitate to get in touch.